What is up, everybody? Logan here again with another video. I'm joined by Halcyon again, and this is a follow-up video from our last video we did where we talked about identifying long-term market trends, and it could also pinpoint you and help you find where the market looks like it's going to topple over. And we talked about another indicator that we used to see when that was going to happen. And I think it's a great video. You guys have yet to go watch that. Make sure to leave a like on this one. And I wanted to say what's up to Halcyon. How are you doing today, my man?
Doing well, homie. Doing well. Excited to talk about this particular aspect because I think that it's pretty common, at least in this most recent environment that we're in, is that we get super zoomed into the daily squiggles, and it's easy to lose some perspective as where we stand in the much larger picture. When in the market cycle, I mean, the market does cycle through. It does different, there's things other than straight up that this market will do. And having at least being a student of what has it done in the past historically, and in particular in the last, I'd say, cycle down, the last two cycles down will be a really good precursor to understanding how it's likely to act on the next cycle down. And so one of my favorite, I would say probably my number one tool for keeping myself in a perspective of what's going on with the markets is using what I call the confidence indicators. So a mentor of mine from way back when, he's passed away since, but this was one of his favorite tools to use to help gauge what's going on under the surface of the market and to then appropriately position yourself for that. So what we're looking at here is called the confidence indicator, and there's a whole bunch of different individual traders, companies that use the term confidence indicator in different contexts. In this particular one, it's helping us understand where the risk in the market is pointing. And that's a pretty important thing to do because it's not pointing in the sense of, there is pretty common with Barron's as a confidence indicator that is looking at what does retail investors, how are they feeling? Are they super bullish, bearish, neutral? Obviously, when everybody gets on one side of the table, then they tend to say do the opposite of that. Right now, everybody is uber bullish on the market, and let's take that for what it is currently. This particular confidence indicator, though, is really looking at what is institutional. This seems odd, but what is institutional bond money doing? And how are they perceiving and acting as it relates to risk? And the reason you're interested to know this particular aspect is because of the fact that the bond market dwarfs the stock market as it relates to assets that are inside of it. I mean, it is tiny. The stock market is tiny in comparison. So there's quite a bit more activity, quite a bit more money flowing in and out of the bond side of it, whether you're looking at governments or corporates or high yields or whatever. Okay, so there's just a ton more money there. The other interesting aspect is that the vast majority of trading that takes place there is on institutional level. It's very tiny in comparison to a retail investor trading in bonds. In fact, name a single person you can think of, name a single Discord you're in or otherwise that relates to bond trading. And I bet you can't name anybody nor can you think of a single Discord that does that.
Nope.
Right, so it's kind of the exclusive institutional club is bond trading. Now, what this indicator is telling us is how are the institutions viewing risk and what are they doing to either participate with that or combat against it. Okay. Now, simply put, this is just a ratio. I'm pretty confident you can do this in TOS in terms of creator ratio. This is one of the few things I use stock charts for, is because they make this super easy to do. But it's basically you can divide one position into another and it will create a ratio you can track. And essentially, if the position, whatever you use first, right? So in this case, I'm using basically a high yield versus a quality bond. So you could use something like TLT or TLT is kind of the default if you're going to use something that's a bond. But basically use like junk, JNK, or HYG, high yield, and you're going to divide that into whatever your quality bond is. So like TLT, you could use some shorter stuff like IEF or maybe even AGG. There's a couple different ways to do that. But in this scenario, I'm using some super long running mutual funds that operate in the space of the high yield and then the long-term, like high quality bonds. So if you didn't know this, the US bonds are considered the best of the shitty bonds that are out there. So, yes, you can use government treasuries from other governments, but as it stands now, the US government bonds are still considered the full faith and credit, and they'll pay back whatever they put out there. Now, your stance on that is your own stance on that. And whether you believe it or not doesn't matter. The point is that's what it's perceived as currently. So thus I use that as the stable side of things. And then high yield is sort of the complete opposite. High yield is companies that have shown they are a piece of garbage, and thus they cannot be trusted with borrowing money. So they're sort of like your regular person trying to buy a house. They have no job, no income, and they're trying to get, lending. And they're going to get horrendous rates for that. And hence high yield. That's why these companies have to pay a high yield to get their, to borrow money. Anyway, so you create this ratio, and it will give you an interesting kind of map as to when risk is flipping over from being the institutions being aggressive or being conservative. And the way you view this is as such. Let me just quickly annotate on this. All right. This is a weekly chart, by the way. So as this is going up, this means that it's a risk on environment. And the risk on means that there is more money flowing into high yield, which means the institutions are way less concerned about the market crashing on them, versus when it's flowing into treasuries, you're going to see this line going down, and they are then taking risk off. So I usually refer to it as the risk on or risk off type of environment. So when risk is on, we see this line going up, and risk is off, see it going down. Now, here's the interesting thing and why I use this pretty regularly. Again, I don't use this to make a trade, like a day type trade. This is more of giving me a sense of which direction is the trend flowing, which direction is the risk flowing here. So like here's the 2021, right? In 2020, we were seeing this downtrending. Interesting, this has been going on for almost a year prior to the pandemic explosion of the risk off side of things. And essentially, the way I use this is I just throw on a 55-day moving average, 55 weekly moving average, which is this blue line. If you can't tell, it's blue here. And all I'm looking at is whenever the ratio is going above or below it, that's giving indication of make some kind of action point on this. Mm-hmm. Okay. As we stand now, so you can see, and I put these little green lines in. Oops, sorry, I moved my annotations, but I put some green lines in here and red lines when these are crossing over and when that would be an action point to do something. I haven't done that most recently because it really hasn't mattered lately, but most recently, like here was the one back in 2003, which was, hey, get bullish on the market. Here's the one in 2000, check this out. This is in let's see, September of 2007, to start positioning yourself for downtrending markets. And that obviously happens right before 2008 and the absolute destruction of the market in 2000, late 2007 into all the way through 2008 into early 2009. And then on the flip side, get back and get long back in April of 2009. I can tell you right now from trading in that was a very tiny opinion of folks is to get bullish. That there was very few, if any, technical indicators saying go bullish in the market, other than you were kind of speculating that, well, they're going to pump money in, maybe it'll push it up. But at that time, that was kind of an unheard of thing. Again, in 2011, I think it was June of 11, there was a get bearish time. If you watch the market, you'll see that this indicator usually is a good month to 2 months ahead of whatever's going on with what the market's doing. Now, if I take and slap the S&P back on here, we'll be able to take a look at what's going on with that, right? So now you can see this little gray line that's underneath this. That's the S&P running and corresponds to what the risk on, risk off is doing. Okay. So again, you can see at this one, this is basically the peak of the S&P. I think it was quite literally near the absolute peak before the market turned down. Yeah. You had, again, this interesting of like 2019 into 2020. I remember seeing this crossing under and seeing like, this doesn't make any sense. What am I missing here? Because the institutions that at that time, they are transitioning away from high quality and transitioning away from the high yield and going into high quality and saying, we need to start putting some risk off in the portfolios. But the market just kept going up and up and up and up, right? And then eventually we got back to, like, think of it like from a shorting perspective, when you go below your moving average, every time you come back to touch it, you usually short there.
Yep.
I might touch it short there. And that was, obviously when I came back and touched again back in January of 2020, that was the time to get short again and just cratered the market. And since that time, you cross back over in September. Again, this is a weekly chart, so this is kind of lagging with this kind of big giant drop. You're obviously going to take a hot second for the averages to move back up. Yep. You potentially could make this a shorter, maybe like a 34 EMA, but I've always used 55 and it seemed to serve me well. What I want to bring to the attention is we are currently doing this right now, right? We're starting to drive ourselves back towards this moving average, and we're starting to see the moving average starting to flatten out here.
Yep.
Which again, those are all the precursors that need to happen in order for this thing to go back underneath it, and then eventually have the market get pulled along with it. Again, this is usually a couple months heads up before this takes place. In this current environment we're in, it happens faster and faster nowadays. But the reality is, for me, as long as I'm above my moving averages and the ratio is generally going up, then I can pretty much say I'm risk on and be very heavy risk oriented. As soon as it starts to flatten the moving average, we start seeing the ratio going underneath it, then I'm going to be way more selective in my trading. And again, I just use it as a compass, as a kind of a broad map of what direction I want to be. Obviously, in this period of time, this was a place to say, all right, doesn't make any sense S&P is going up because my risk is getting turned off. And, the institutions are unloading capital here. I mean, for them to be able to transition from one end to the other, it's a couple month process for them to do that. It's not like they can just say, all right, hey, Frank, hit the sell 100 billion button. They would absolutely crater the market against themselves if they did that. So it's all right, we're going to sell,
Frank,
200 million today, and we're going to work this process for the next 2 months because we've decided whatever metrics we're looking at are telling us to get safer. Right. They also have a bunch of rules on the institutional bond side of things that are very different than the way that the stock market operates. So again, they have, because so many pensions and funds like that are all wrapped into it, and schools who have a bunch of their stuff that's all wrapped into as well. I'm drawing a complete blank on what the schools call it, the endowment funds. All that is stuff that is, they have to be super careful about that. So again, it gets a really interesting insight to what's going on with this. And again, it's something that you should put in your tool bag of pay attention to when you're doing your really big kind of maybe once a month or once every 2 weeks kind of top level market view, see what this is doing. Because if it starts falling below those ratios, you should start being a bit more careful of how you're positioning your portfolio.
Yep.
Every single major stock market crash that has ever happened, always this ratio precedes that taking place. Okay, so it's something to pay attention to once it finally does happen, because it also will give you a complete edge once you're in that environment. It's a lot easier to trade when you know they're in the environment.
That's awesome.
So there you go. This is a little bit of that follow-up from what we talked about. Again, we'll expand on another one, a little more details when we get some questions on this. But again, I'm using the FAGX and the VUSTX fund, FAGIX and VUSTX for creating the ratio.
Yep.
But you can completely do this with JNK or HYG for the high yields, and then use like TLT or AGG for the bond side of it. And that's how the ratio, you can make it that way too. It looks pretty similar if you were to create it that same way. I just don't think they have as much data available because they weren't around that long. So I think you would stop somewhere around like 2009 or 10, but because I want to see further back data, I use those funds that have been around forever. And there you go. So one of my favorite tools, probably my number one tool for looking at the bigger picture. And like I said, I am definitely paying attention that I'm starting to see this downtrending motion here, which means to me that while even though the stock market's going up, the institutions are doing something behind the scenes here.
Yep.
On the bond side of things. And they are looking at removing some of the risk. Again, you also take a look at like TLT right now. What is it doing? It's been rising up. It was 130 something, 2 months ago, and it's at 150 right now. So you're seeing money is starting to flow into those. And again, you can make an argument as to why that might be. I really don't care why it is, to be honest. The fact is that's what's happening at the moment. And, we just need to be heads up right now. I don't think there's an action point to be done immediately here, but it is like, all right, put it in my, list of things that I check to see when does the market start turning, because eventually it will. And then we'll go from there with it. So we'll keep you updated once we do see this thing finally flip over. We'll call it out and let people kind of, see what it is in real time. So that's the heads up.
Well, and I appreciate you walking everybody through this, and I'm learning as well. And what makes it nice is you're on my side. And I would say there's a lot of traders who don't have someone else to talk to while they trade all the time to like clear their brain with this stuff. And to really
Yep.
sit and look at like, hey, where is the risk flowing? Where is the money flowing? What is happening underneath that? Like I wouldn't even have thought to look for this trading before you talked about it. To me, a couple months ago, you mentioned it, but to actually see it and then do a video on it and to progress with it. So, I
Yeah, it's
wouldn't
definitely
even
very
look for this.
counterintuitive, that's for sure. I mean, definitely that, in fact, most traders have never heard of this period using something like this.
Yeah.
But this was a legacy passed down by my mentor Terry, and this is a critical component of keeping yourself on the right side on big long-term investing in particular. I mean, there's obviously ways to take advantage of it in the shorter term, but on long and term investing, this is you want to know a heads up when that market correction is coming. And this is one of the best ways I've found, if not the best way I've found, to keep myself on the right side of the coin there.
Awesome. Well, I appreciate it, man. Thanks for coming on again. If you
You
guys
got
have
it.
a like or a subscribe or comment or everything else, do it now. And we will see you guys in the next one.
Do it now.
Do it now.
All right. We'll see ya.